Pan American Silver Corp. PAAS has executed a transformative strategic shift, culminating in the major acquisition of Yamana gold assets in 2023. This transaction fundamentally repositioned the firm, evolving its profile from that of a specialized silver producer to a diversified, large-scale precious metals miner operating across Latin America. The investment thesis for PAS rests firmly on its demonstrated ability to convert this increased operational scale into superior, highly efficient free cash flow generation, underpinned by structural cost advantages and a resilient balance sheet. The success of this strategic pivot is evident in PAS's market performance. Over the past year, the company delivered a total return of approximately 49.5%, significantly surpassing the 16.9% gain achieved by the S&P 500 over the same period. This outperformance was not merely coincidental with rising metal prices, but was fundamentally fueled by a dramatic increase in operational efficiency, leading to earnings growth that surged by 291%. Sustained revenue trajectory and validation of scale. The expansion of the company's operating base is clearly visible in its top-line financial metrics. Pan American Silver has recorded consecutive years of significant revenue growth, confirming the accretive value of the acquired assets and the successful integration of its new portfolio. Annual revenue for 2024 reached $2.819 billion, representing a 21.71% increase year-over-year. This followed an even more substantial expansion in 2023, where annual revenue of $2.316 billion marked a 54.95% surge from the 2022 figure. The most recent reported data confirms continued momentum. Revenue for the trailing 12 months, TTM, ending September 30, 2025, reached $3.255 billion, an increase of 21.75% over the previous TTM period. This pattern of sequential, double-digit revenue expansion across multiple reporting periods is critical for fundamental analysis. While a temporary spike in revenue might be attributed solely to cyclical increases in commodity prices, this sustained, large-scale growth validates the permanent structural uplift provided by the M&A activity. The expanded scale inherently reduces per-unit fixed costs and enhances resilience, demonstrating PAS's stability as a mid-tier leader capable of weathering typical commodity price volatility. Nuanced analysis of income statement dynamics. The income statement reflects Pan American Silver's transformed operational structure, characterized by robust revenue generation and stringent cost management, particularly as the company integrates its highest-grade assets. Revenue mix and operational context. For the third quarter of 2025, Q3 25, the company reported a record attributable revenue of $884 million. This strong performance is a direct reflection of the expanded operating base following the Yamana transaction, which had already driven a 64% increase in revenue in Q2 2023 compared to the preceding quarter. The transaction significantly altered PAS's commodity exposure, increasing the share of gold in the overall sales mix. Although the company maintains its foundational status as a major silver producer, the substantial contribution from gold sales provides a crucial counterbalance to volatility inherent in the silver market, enhancing top-line stability and overall portfolio risk management. Cost structure and the all-in sustaining cost metric. In the capital-intensive mining sector, profitability is most accurately gauged by cost controls, with the all-in sustaining cost, AISC, being the most comprehensive non-GAAP metric employed. AISC incorporates not just direct operating expenses, but also the cost of ongoing capital expenditures required to maintain current production levels and life-of-mine plans, as well as necessary exploration efforts. For Q3 25, the company's attributable AISC stood at $15.43 per silver ounce and $1,697 per gold ounce, excluding net realizable value adjustments. These metrics serve as the current baseline for consolidated operational efficiency. However, the future trajectory of these costs is expected to undergo a significant reduction, driven by the full ramp-up of the ultra-high-grade Juanicipio mine in Mexico, in which Pan American Silver holds a substantial interest. The Juanicipio joint venture is forecast by its operator, MAG, to produce a substantial volume of silver, estimated to range between 14.7 million to 16.7 million ounces in 2025, with Pan American Silver's net attributable share expected to be between 6.5 million and 7.3 million ounces. More importantly, Juanicipio is expected to operate at an exceptionally low AISC, projected to be just $6 to $8 per silver ounce in 2025. The integration of this high-volume, low-cost production center is projected to have a profound deflationary effect on the consolidated silver segment AISC. The capacity to integrate production that costs less than half of the current consolidated average will structurally pull down the overall cost profile of the company's silver operations. This structural cost improvement is a strategic advantage that allows PAS to generate durable margins even in periods when silver prices are less buoyant, setting it apart from smaller pure-play silver producers whose margins are more acutely exposed to rising industry-wide input costs. This focus on optimizing operational efficiency through asset quality provides a clearer path to long-term profitability than relying purely on commodity price appreciation. Quality of earnings and adjusted profitability assessment. Reported statutory profitability for Q3 25 showed net earnings of $169 million, translating to $0.45 in basic earnings per share. However, a closer examination of the income statement reveals that these earnings were subject to several material non-recurring adjustments common after large-scale mergers and asset rationalization efforts. The company's adjusted earnings, which strip out these non-cash and one-time items, were notably higher, at $181 million, or $0.48 in adjusted earnings per share. The primary difference between the two figures was related to a $21.7 million loss recognized from the sale of subsidiaries. This figure included a significant $28.6 million reduction to the gain previously recognized on the sale of the La Arena SA mine, resulting from net working capital adjustments. Conversely, the statutory net earnings also included a positive contribution of $16.3 million of income derived from the investment in Juanicipio. The fact that adjusted earnings exceed reported net earnings indicates that when divorced from complex accounting impacts related to prior asset sales and working capital adjustments, the underlying core operating profitability of the consolidated entity is stronger. This consistency in operational profitability, supported by the material income from Juanicipio, is essential when assessing the trajectory of the firm's earnings capacity post-acquisition. The full year 2024 confirmed strong results, with net earnings of $112.7 million, 0.31 basic EPS. Exhaustive cash flow statement assessment. For a capital-intensive business like mining, the cash flow statement often provides a more truthful and less manipulated view of economic performance. Pan American Silver's cash flow generation metrics for Q3 25 were exceptional, validating the operational scale achieved through the Yamana transaction. Operating cash flow generation and disparity with earnings. The company reported record attributable cash flow from operations (OCF) of $323 million in Q3 25. This figure represents a nearly 44% surge compared to the $225 million generated in Q3 24, confirming a rapid acceleration in cash conversion power. The unaudited cash flow from operations was $308 million in Q3 25. A key finding from the Q3 25 results is the significant positive variance between the attributable OCF of $323 million and the reported net earnings of $169 million. Cash flow from operations is nearly double the reported net income. This substantial divergence is common in the mining sector, especially following major M&A activity. The GAAP income statement typically records large non-cash depreciation and amortization charges, DA charges, resulting from the fair value accounting of acquired assets. These non-cash charges significantly depress reported net income while having no impact on the underlying operating cash generation. This observation validates the industry standard of favoring cash-based metrics, such as EV to EBITDA or price to cash flow, over the traditional price-to-earnings ratio for cyclical and capital-intensive companies. The fact that the P&L statement actively masks the true cash profitability of the consolidated business confirms that the firm's true economic performance is substantially higher than suggested by statutory net income figures. Capital efficiency and record free cash flow. The efficacy of management's capital allocation strategy is best measured through the free cash flow (FCF) metric, calculated as net cash generated from operating activities less sustaining capital expenditures. PAAS reported attributable sustaining capital expenditures (CapEx) of $71 million in Q3 2025. Sustaining capital represents the minimal investment necessary to maintain current production capacity and mine life. The combination of extremely high OCF and contained sustaining CapEx resulted in a record attributable free cash flow of $251 million in Q3 2025. This compares highly favorably to the $150 million generated in Q3 2024, demonstrating rapid expansion in discretionary cash available to management. The ratio of sustaining capital expenditures, $71 million, to attributable OCF, $323 million, is notably efficient, standing at approximately 22.2%. This high conversion ratio signifies that over 3/4 of the cash generated from mining operations is immediately available as discretionary FCF. This capital conversion power is a primary factor driving the stock's recent market outperformance and provides management with immense financial flexibility for strategic initiatives and shareholder returns. Examining momentum, the Q3 2025 FCF of $251 million alone represents nearly 57% of the company's entire FCF generation for the full year 2024, which totaled $445.1 million. This dramatic acceleration suggests that PAAS is currently operating at peak efficiency and benefiting significantly from strong metal price realization. The annualized run rate based on the Q3 performance places the company's forward FCF capacity potentially well above the $1 billion threshold, offering a powerful indicator of future value creation. IV, balance sheet health and solvency profile. In the highly cyclical and geographically exposed precious metals sector, balance sheet strength is paramount to surviving downturns and enabling opportunistic growth. Pan American Silver currently operates with an exceptionally robust solvency profile, having achieved what is effectively a net cash equivalent position. Liquidity and operational buffers. As of September 30, 2025, the company maintained a significant liquid position, holding $910 million in cash and short-term investments. This amount excludes an additional $85 million representing PAS's 44% interest in the cash reserves held at the high-grade Juanicipio joint venture. Beyond direct cash holdings, total available liquidity was $1,660 million. This comprehensive measure includes the substantial cash and short-term investments, plus the full $750 million undrawn capacity under the company's revolving credit facility. This level of liquidity provides a massive operational buffer against adverse market shifts. Furthermore, the company maintains a strong working capital surplus, defined as current assets exceeding current liabilities, amounting to $1,006 million. This robust current position ensures that the company can comfortably meet short-term operational and financial obligations without liquidity strain. The company also reports total assets of $9 billion against total liabilities of $2 billion, confirming a highly attractive long-term asset-to-liability ratio. Debt structure and leverage analysis. Pan American Silver carries a total debt load of $857 million. This debt primarily comprises senior notes in addition to certain lease liabilities and construction loans payable. A direct comparison between the cash and short-term investment holdings, $910 million, and the total debt, $857.0 million, confirms that the company is operating in an effective net cash equivalent position. This structural absence of net debt is a hallmark of financial conservatism and stability, especially critical in an industry prone to volatile financing costs. The company's ability to service its debt is outstanding. Pan American Silver reported earnings before interest and taxes, EBIT, of $823 million, yielding an extraordinary interest coverage ratio of 64 times. An interest coverage ratio of this magnitude virtually eliminates the risk of financial distress. The combination of an effective net cash position and the capacity to cover annual interest payments over 60 times provides unparalleled competitive insulation. This allows management to concentrate capital and attention on maximizing operational performance and pursuing strategic growth initiatives rather than being distracted by constant refinancing risks or liquidity concerns. V. Dividend Safety and Capital Return Program. Pan American Silver's capital allocation strategy prioritizes sustainable shareholder returns backed by high cash flow generation, a prerequisite for stability in the cyclical mining environment. Coverage and sustainability metrics. The company's commitment to shareholder returns is reflected in its most recent dividend distribution of 0.14 cents per share with an ex-date of November 2025. This translates to an annualized payout of 0.46 cents per share, providing a current dividend yield of 1.08%. Notably, the most recent distribution marked an increase of 17% in the dividend compared to prior periods. The safety of this dividend is confirmed through stringent coverage metrics. The payout ratio based on statutory earnings stands at 26.4%. However, for a cash flow-focused business, the free cash flow (FCF) payout ratio provides the ultimate measure of sustainability. The analysis indicates that the dividend is extremely well covered by FCF, with the company paying out only 20% of its cash flow last year. This low FCF payout ratio is the single most important indicator confirming dividend security and longevity. By committing only 20% of the highly reliable FCF stream to dividends, the company retains 80% of its internally generated cash for growth capital, debt management, or opportunistic share buybacks. This deeply conservative approach ensures the dividend remains robust and sustainable, capable of enduring moderate fluctuations in metal prices or unexpected operational issues without necessitating a cut. This sustainable model contrasts sharply with some mid-cap peers who often maintain higher, less secure payout ratios. Supported by its record FCF generation and massive total available liquidity of $1.6 billion, management has clearly outlined a flexible approach to capital deployment. The chief executive has explicitly committed to solid shareholder returns through a dual strategy encompassing both dividends and opportunistic share buybacks. This dual-pronged capital return strategy is highly advantageous. While a stable dividend provides predictable income, the allocation of excess capital towards strategic share buybacks offers a more flexible and often more tax-efficient means of returning value to shareholders when the stock is trading below its intrinsic value. The financial capacity to implement this strategy is firmly established by the company's minimal leverage and high FCF conversion power. V. Current valuation and relative peer analysis. Determining the fair value of a precious metals miner requires careful selection of appropriate valuation methodologies that account for the sector's unique characteristics.
Methodological rationale. The traditional price-to-earnings (PE) ratio is inherently limited in evaluating mining companies. As demonstrated by PAS's own financials, where Q3 2025 OCF was nearly double net earnings, the PE metric is susceptible to significant distortion from non-cash accounting charges, like depreciation and amortization, especially following large acquisitions. A look at the competitive landscape confirms this volatility, with peers exhibiting wildly disparate PE ratios, e.g. Equinox Gold at 175.90 times versus IM Gold at 33.51 times. Consequently, the enterprise value to EBITDA, EV/EBITDA, or the enterprise multiple, is the superior metric for valuing cyclical, capital-intensive firms like Pan American Silver. EV/EBITDA is calculated based on the total enterprise value, which includes market capitalization, total debt, and cash holdings, relative to cash profitability before D&A, interest, and taxes. By stripping out non-cash accounting noise and neutralizing differences in capital structure, debt versus equity, EV/EBITDA provides a clearer, more comparable picture of operating profitability. While value investors traditionally seek an enterprise multiple below 7.5 times as a preliminary indicator of value, it is imperative to apply industry and contextual factors for accurate analysis. Valuation based on cash generation and relative benchmarking. The substantial gap between reported net earnings, $169 million, and free cash flow, $251 million, immediately suggests that Pan American Silver is likely undervalued when assessed strictly on a price-to-free cash flow basis. The robust interest coverage, 64x, and the effective net cash equivalent position further minimize the need for a high-risk premium to be factored into the valuation. In the context of peer comparison, POS should be benchmarked across two primary groups: specialized silver miners such as First Majestic Silver, Hecla Mining, and Endeavor Silver, and diversified precious metals majors such as Wheaton Precious Metals and Agnico Eagle Mines. The data strongly supports the argument that Pan American Silver merits a material valuation premium over pure-play silver specialists. First Majestic Silver, for instance, trades at a high PE ratio of 116.79 times. Yet POS's financial profile exhibits far greater stability and de-risking factors. The superior valuation should be afforded to POS due to the convergence of three powerful factors: balance sheet superiority, the effective net cash equivalent status and immense liquidity, $1.66 billion, provide unmatched financial insulation against cyclical downturns. Structural cost advantage. The confirmed integration of the ultra-low-cost Juanicipio asset, which is forecasted to dramatically reduce the consolidated silver segment AISC to $6 to $8 per ounce, ensures long-term margin durability. FC conversion power. The high conversion of operating cash flow into discretionary free cash flow, with only 22.2% required for sustaining capital, indicates operational maturity and highly efficient capital expenditure, justifying a higher cash flow multiple. The confluence of strong leverage ratios, accelerated FC generation, and a guaranteed forward cost reduction catalyst significantly mitigates the sector-specific risks associated with precious metals mining. This creates a superior risk-adjusted profile that should translate into an enterprise value multiple exceeding the average industry benchmarks. VII. Synthesis and concluding observations. The comprehensive financial analysis of Pan American Silver Corp reveals a company successfully completing a fundamental transformation, solidifying its position as a major, diversified, and financially robust player in the precious metals sector. The investment case is no longer reliant solely on speculative silver price movements, but is anchored in verifiable improvements to scale, efficiency, and balance sheet quality. The income statement confirms successful revenue scaling, highlighted by the sustained double-digit revenue growth and the strategic inclusion of higher gold sales for portfolio stability. Critically, the forthcoming integration of the Juanicipio mine at projected AISC of $6 to $8 per silver ounce promises a structural deflationary effect on the company's cost base, securing superior long-term operating margins compared to peers. The cash flow statement provides the most compelling evidence of underlying strength. The generation of record attributable operating cash flow, $323 million in Q3 2025, which significantly exceeds reported net earnings, confirms that non-cash charges are masking true economic profitability. The resulting high free cash flow conversion rate, over 75% of OCF is discretionary FCF, provides management with exceptional capital allocation flexibility. The balance sheet is a source of immense competitive strength. The company's effective net cash equivalent position, coupled with over $1.6 billion in total available liquidity and an extraordinary interest coverage ratio of 64 times, insulates the firm against sector volatility and financial distress. This de-risked financial posture is highly valuable. Finally, the dividend is secure and sustainable, supported by an ultra-conservative free cash flow payout ratio of just 20%. This strategy, coupled with a commitment to opportunistic share buybacks, indicates efficient management of capital surplus. Based on these factors, the current valuation, while obscured by statutory PE distortions, is likely undervalued when assessed against superior cash flow multiples. The company's structural advantages, particularly the low-cost Juanicipio production and its exceptional financial health, justify a significant valuation premium over traditional pure-play silver companies, positioning Pan American Silver for continued strong performance across various commodity price environments.